Hello and welcome to this special webinar from Fat Profits. My name is Roger Malik. I'll be your host for today. I'm the Head of Client Services in our Sydney head office. And joining us today is our Senior Account Manager, Edward Allen. Edward, welcome to the webinar. How are you today?
Yeah, g'day Roger. Always a pleasure. And we've been doing a few of these lately, so it's become the norm for me. So yeah, pretty excited to be here today. There's a lot going on in the markets that we need to share.
Absolutely. So this is a good chance for us to provide an investor update to people who've been in our database for some time. So this presentation from Fat Profits is general in nature. We're not taking your personal situation into account. So if you are looking for that, please see a financial planner or advisor before acting on any information provided in today's webinar. Also, past performance is not a reliable indicator of future performance. But during this webinar today, we do have a lot of people watching this as always. Look, we have a lot of people in our database who've been getting information from us from time to time. And so we encourage you to ask one question each at max, because otherwise we won't be able to get through those questions, because I know the capacity for today's webinar is max 500, and I can see here on my screen there's about 400 odd people. There might be a few joining us later as well. So if you want to ask questions about stocks or market, please type them in on your box where you see that there now, and we will do our best to answer as many questions as possible. And there's a lot going on in the market. So what we're going to discuss today, firstly, we will look at the ASX 200, where we're at and where our projections are. We will give away today 2 stocks to avoid, 2 stocks to sell, and 2 stocks are currently buy from Fat Profits. We'll also give you a free website tour of our members area. We'll look at who Fat Profits are, what we do, how we can help you. We'll also share our dividend portfolio for those of you looking for high quality dividend stocks. And there is a very special offer today to join our service. And finally, towards the end, we will discuss one hidden gem. There is an absolute golden opportunity with this particular stock. And if you've got your pens and papers, we will discuss that towards the end. And also, of course, we can't go without talking about commodities and mining. There's a lot happening in that space. So firstly, let's get into today's discussion. Of course, we all know what's going on with Russia and Ukraine. With the war situation, lots is changing in the financial market. So first thing which is being affected is the supply of oil, as Russia is being banned by many countries, including US. So what's happening to oil? Of course, we all know oil price has gone up dramatically, but it also been pretty volatile in the recent few sessions. So it's going up and down. Now, if you're holding oil stocks, you're probably feeling happier because oil companies are going to make more profit. If you're not holding oil stocks, should you be buying right now? Our general advice is probably not best to chase oil stock right now because they've already had a pretty strong run. Maybe better off waiting for a pullback and then buy. But at the moment, currently we are reviewing all our oil stocks in Fat Profits portfolio. Next sector, which has gone up dramatically as well, is gold. The reason? Well, it's considered a safe haven. In volatile times, people flock to safe haven stocks and sectors. Gold has always been one of those. So it's broken out, as you can see in the chart, it's broken out of a descending triangle and it's gone to the upside. It has recently touched its previous all-time highs of 2,080 US dollars an ounce. So what is our view on gold? We are quite bullish on gold. We do think it's important to have a couple of good gold stocks or ETFs in your portfolio. So if you're holding some gold stocks right now, you're probably feeling happier. Does gold have more legs for it to go forward? In our view, yes. Will it be smooth sailing? No. If you're not holding gold stocks, should you be looking at a couple? Absolutely. What are they? We'll discuss one of them later on today, but we've got a number of gold stocks in our portfolio. Do you want some juniors or some producers, we've got a range of stocks within our portfolio. So depending on what you're looking for, we can help you with that as well. And of course, the other thing which has happened as well with the war is there is a huge inflation in food, agricultural commodities, and of course that has spiraled a lot of the commodities, including what you're seeing on your screen right now is wheat, others like corn, coffee, soybeans, you name it, everything is going up. So how do you play that? Well, there are a number of stocks in the ASX where you can invest. We've got a few that we'll talk about today. And finally, before we look at Edward's point of view as well, recently we've seen inflation figures in the US skyrocket to 7.9%. What does that mean? That's the highest inflation on record in the last 40 years. Everything is more expensive compared to last year by 7.9%. And that means we are going to see interest rate rises in the US very, very soon. And that is good for financial sector. That is also good for commodities. And that is also good for gold and precious metals. So there's a few tips for you to check out. Now, Edward, let's have a look at the S&P 500, if we can get your views on the US market. So we've seen a huge drop in the last couple of months. What's Fat Profit's view on where the markets are likely to go in the near future?
Yes, Roger. Last year, Angus reported our Baker's Dozen, which is our top 12 predictions for the year. And a few of them have already played out. So one of them was a 15% correction in US markets, S&P 500 and NASDAQ as well. And that's now well in play from the start of this year. The other prediction was oil spiking to close to $200 a barrel. That's now happened as well. And gold pushing on 2,000 above. So we're well in play at the moment with our predictions for 2022. The underlying support you can see on that chart at 4259 has been tested, and it's bounced off 3 times already this year. So it's not going to be smooth sailing from here. So we've had 3 mini crashes already in 2022. So what we're telling members is that potentially on certain stocks and sectors that we are exposed to, there are still some pretty good buying opportunities, and we put those out generally when the market has those mini crashes. But it's going to be an interesting ride over the next 6 to 12 months, that's for sure.
Excellent. Well, there is also, if you look at the ASX 200 on the other hand, you'll notice that we haven't dropped as much, and there are obviously a couple of reasons. One of them is we are heavy in commodities, and commodities have had a good strong run even with the war. But also, look, our view on ASX 200, Ed, I mean, if the war situation calms down, what can we expect if there is some peace talks?
That's right. At the moment, again, we predicted a correction, but we've also predicted that the ASX will be much higher in around, well, after the next reporting season. So we're talking from August to December, where we're looking for a Christmas rally at the moment. But the markets are going to be volatile for the next 3 months. We've got this war in Russia, which is still playing out. We've got inflation, core inflation at record highs. We've got interest rates starting to rise. Here at home, we've got an Australian election coming up in May, and then we've got tax season in June. So we're playing the cautious game at the moment, but there are buying opportunities, but we're also avoiding a whole number of sectors and stocks, and we'll get into that very shortly. But we're at the crossroad. Again, if the US sneezes, Australia coughs. We've had 3 mini crashes here already this year as well on our index. It's going to be a bumpy ride from here.
Yeah, you're right. Thank you, Ed. Now let's have a look at, well, Australian companies. We are sitting after the reporting season just finished in February, March. We've seen companies are sitting at record cash levels. This chart shows you for the last 12 years, the cash on hand on the ASX 200 companies. And you can clearly see the last 1-2 years have been huge, tall buildings, and that is just showing confidence in our ASX markets. And the other thing which you can expect as investors is some record dividends as well in the next reporting season, because you can also see here in another 10-12 year chart, yes, we saw this big drop in 2020. You can see where the mouse is, the smallest building there, but from then we can see the dividends have improved, and now we're well above average, and the dividends have improved. The likes of BHP, Rio Tinto, they have paid out record dividends. Banks have improved on dividends. The likes of Telstra maintain dividends, but also plenty of other companies are flush with cash. So we have a lot of confidence on the ASX. Now, looking at that, Fat Profits, we provide an income portfolio for our paying members, which currently consists of 22 ASX 200 companies. Now, this portfolio, we're hiding the companies on the left because obviously we can't give away all that information for free, but we are willing to share our results, and these are all black and white. You can see the prices of these stocks, the dates we bought them, current price, the capital return per stock, the income return, which means dividends, how much we've collected, and a total return per stock, and then an annualized return on individual companies. Now, the interesting thing in this portfolio, because a lot of semi-retired and retired investors, and if you are one of them watching this today, they rely heavily on a dividend income. So what do you need is an overall return, and the bottom right-hand side is a quick snapshot for you. This portfolio has been producing, and you're probably hopefully sitting down because we don't want you to fall over. Well, this is producing 18.1% annual returns for the last 10 years on the ASX. And this is a combination of dividends and growth. Now, the question we always ask investors is, how are your results compared to these? So if your answer is, okay, I'm getting 5 to 10% returns a year, well, that's pretty stock standard in the market, because the market does around 7 to 8% a year by itself. So if you're getting that similar to the market, well, at least you're not behind. That's good enough. But would you like it to be better? Well, I'm pretty sure the answer is yes. If you want to improve those results, but still sticking to the top 200 ASX companies, well, this portfolio has been huge for our members, and they follow this pretty much religiously, but not all of them, of course, but they cherry pick certainly stocks out of these. Now, Ed, having a look at this forecast now, this same composition, we're willing to share a few names. This table shows you a portfolio forecast for dividends expected in the next 12 months. And you can see the financial year 2021 net yields in percentages, gross yields in percentages, and which ones pay franking credits 100% or not. But Ed, what are your thoughts on the portfolio average yield that we're expecting this year to be 6%? That's pretty respectable in terms of what we can expect.
Yeah, absolutely. Like I'm going on 11 years at Fat Profits, so I've been around as long as this particular part of our Australian equities report has been published for our members, and all these stocks are in our preferred portfolio of stocks in the members area. So I think we've got about 55 in total preferred stocks in our Australian equities report. So these are 22 out of 55, and the majority have always performed. So these are more your safer medium risk stocks. There's no such thing as low risk, but medium risk core holdings, and they're generally ASX top 200 stocks, 100 to 200, and a couple in the top, quite a few in the top 50 as well. But that's a phenomenal return, 6% at the moment. The best term deposit, I'm not sure, I haven't really looked, but you might get 0.5% if you're lucky. But that will rise. So even in the next 2 years, as term deposits get back to potentially 1.5%, you're still going to be getting an average of 6% out of this particular portfolio, which is still going to be 4, potentially 5 times a term deposit, which are going to come back into play in a few years' time, probably about 3 or 4 years' time, as investors start to cash out of investment properties and putting them back into term deposits. It's generally the cycle, but what we're seeing in the last 12 months is our members have been telling us they've taken advantage of the property market, they've sold out and put them into these types of income stocks in the short term. But as you can see, we've just showed you how much you can make over a decade, and the patient investors just stick with this strategy and they get a massive return at the end of the day. So another way, we can show you how to make money over the medium long term, just simply by following our strategy.
Excellent. Thank you, Ed. All right. Now, Ed, obviously most people watching this today, they've seen information from Fat Profit, so they're probably roughly aware of who we are. But do you mind expanding a little bit more as to who we are, what we do exactly?
Yeah, absolutely. Look, a lot of new investors come onto the market and they sign up for a free report, and we have conversations with them every day. And the biggest theme I've been getting is there's so much information out there. There's so many people doing what you do. And my answer is, well, no, that's not actually the case. Yes, we are in the information business, in research, but the difference between us, firstly, to invest in the stock market, you need to have research to back up your decisions. Otherwise, you're gambling or punting. It's as simple as that. All right. So the people that come to us say, oh yeah, I know about these stocks. Yeah, I know about Telstra. I know about Westpac because I use them every day. But the difference is the reason our members use us is, one, it's an insurance policy for your portfolio. Even if you're starting with $10,000 or whether you've got $1 million in the market, you've got a $30,000, $40,000, $50,000 car, you're going to insure it, right? Before you drive it on the road. It's the same with your share portfolio. You've got to have an insurance policy, and that's research to back up your decision. So there's 2 ways you can get research. One is signing up to a full service stockbroker, where you've got a contract, you buy and sell through the broker will call you every couple of weeks and turn over your portfolio, right? And you'll pay an average of 1% brokerage fee every time you buy and sell. Or you can sign up to a established, reputable research service like Fat Profits. That's why we're one of the leaders in the industry. And all you pay us is a subscription fee, which for most people can be a tax deduction. And all of a sudden, you've got a preferred portfolio of stocks in the market. You've got current positions in the market, so current buying opportunities, a few sells, and a whole bunch of holds. That's what we can show you as part of a service. There is no buying and selling through us, right? So we are independent to full service stockbrokers. So all our members have their own online broking account, which they do their own buying and selling. The other big differentiation between us and the rest is that most of the others in this industry are direct marketers. So you would know, I don't have to mention any, and I won't. You put in your email address and you'll get absolutely bombarded. You'll get a long-winded script about this great stocks or great stocks that are in the market, and at the bottom there's a little box for your email address. Once you put your email address, you'll get absolutely bombarded. Every time you click on one of our emails, another email will come through. If you join one of these services, there will be 12 subscriptions waiting for you. So you sign up to one worth, I don't know, $200, $300. And then there'll be another email that'll come out and they'll say, well, you can sign up to this portfolio and then spend another $700 or $800 and so on. Before you know it, you've paid $4,000 or $5,000 in 1 year. And the reason I know that is because members tell us that every day. I just had a guy join who runs his own business. So he's got a lot of cash generated each month and he needs to put it somewhere. So he puts it in the market and he ended up with 6 portfolios, which is beyond belief. And the guy is very new to the market. He's only been in the market for about 6 to 12 months, and now he's got to repair the damage. So one subscription here, one product where you have an Australian equities report, a global mining report, and then we have global equities in UK for members that have got a larger portfolio who'd like to invest internationally. But we're based in Sydney. We've got an office in London. We've got a wealth management division, which is the other reason our members and people come to us to buy our research, is that we manage close to $1 billion under management across 9 separately managed portfolios, and we also investment manage 3 listed funds actively managed by Angus Geddes and his investment committee themselves. That's why investors trust us. And on top of that, our track record of performance, which we'll go into very shortly.
Yeah, absolutely. Thank you, Ed. That really clarifies it. So this is our picture of our CEO, Angus Geddes. You may have heard him on TV or some of the other channels. So he's our CEO and also our fund manager. We've been around for 22 years. This picture here is David Lennox, our mining analyst. He's also every week on Ausbiz channel or some of the other channels, so Bloomberg, and he's also a geologist. He's been around for 40 plus years. He used to work for Colonial before and plenty of other organizations, including Suncorp. And he's also been a fund manager and portfolio manager before as well. He's very popular in the market, and our members particularly love him because his mining recommendations have actually made a lot of money for our members. And finally, this is our wealth management, where we manage real money, as Edward just mentioned earlier. This is a clear indication of how we've been performing. This is all black and white. The orange line is our Fat Profits Australian portfolio. The black line is the ASX 200, and this is since inception in 2007, before the GFC. And we've been performing at 338%. That's our total return on the portfolio versus the market, which has done 122%. So when you look at that over a long period of time, that is serious money. And the orange worm is well and truly far away from the black ASX 200 worm. So that's a good sign of things to come. So what do? We provide you the research. We follow this man's philosophy, Warren Buffett, and he always is a medium to long-term investor. And he follows the simple philosophy is buy when others are fearful and sell when others are greedy. But over a long period of time, he's been extremely successful. That's what we do. And pretty much, we're not traders. So anyone looking to buy stocks and sell stocks, look, that's not our service. We're not buying and selling like traders, buying today, selling next week. That's not our service. We like to hold stocks for a long period of time, at the very least, at least 12 months, for multiple reasons. But anyone who's trying to time the stocks will know that that comes with a lot of pain, a lot of headache, and at the end of the day, a tax bill, and more often than not, you end up in the red as well. So we buy quality companies, buy them low, sell them high over a long period of time, collect dividends as well along the way. That's our philosophy. So at the moment, if you look at the sector, there is a lot of rotation taking place. Now, while broadly speaking, we can categorically tell you that our preference at the moment is financials and commodities. Commodities because they are in a new super cycle, and that's remaining probably for the next 3 to 5 years in our view. So you must have good quality commodity stocks. Financials, we will see interest rate rises all around the world, including Australia, and financial stocks will benefit. Does that mean all financials will benefit? No, we are going to show you a couple of examples shortly of financial and energy companies still struggling in current environment. So you still have to be picky. On the other hand, tech stocks, broadly speaking, they are getting smashed. So broadly, that's not a sector you want to be in, but there are exceptions. Property, similar. Broadly speaking, it is expected to be down over the coming couple of years, but there are exceptions here. So you must be picky, you must do your research. So let's give you the first section today, is 2 stocks to avoid. Now, Ed, these are the 2 stocks we know very well. First stock we'll cover is Magellan Financial Group, and the second one, AGL. Even though Magellan is a financial company, and our view on the financial sector is it's going to go up, but Magellan is actually going reverse, and so is AGL in energy space, unlike some of the peers. So let's have a look at Magellan first. So Ed, this company we know very well because the chart will show the story, but we've held this stock in the past and we've sold it for a huge gain. In fact, one of our biggest gains we've had was this stock. So can you tell us a bit about the previous success we've had and why we've been avoiding it for the last couple of years?
Yes, look, as you can see there, the historical chart, we got in at the right time. I remember we bought this stock just after I joined Fat Profits in 2011, $1.74. Even we in the team, the account management team, didn't know much about this business, but it was a junior fund manager. Hamish was running this business, and he's grown it to an astronomical powerhouse by 2019, right? Now, at the start of 2019, we took a massive profit, as you can see on that chart. We sold it at around 25.82. Post that, post that sell half, we saw a massive rise, and you can see that in the chart. So it just went through the roof, and that was the peak. That was the peak for Magellan. Now, what's happened since is they've lost their biggest customer, which is basically 15% of their business. And Hamish is obviously going through a divorce at the moment, so he stepped aside. So fundamentally, the business is very weak. And anyone that was on this webinar in the last few months would have seen that we've been avoiding this stock at around $20, $21 per share. And we've been telling our members in our weekly webinars to avoid not only this stock, but a multiple of other stocks. And we've actually done the right thing, because I've had heaps of members calling and asking me whether it's a turnaround story, and the answer has always been no. The fundamentals are just way too weak, and we have far more superior stocks in our portfolio paying quality dividends. Why would you chase a falling knife? And that's what this has ended up being. So fundamentally, an absolute avoid.
Yep, absolutely. And I might point out, look, we don't always get it absolutely perfect. While the buy was perfect, $1.74 when they were junior company, as Ed said, look, we did sell out at 25.82. You might argue and say, look, it did go up to 70, so we potentially missed out on that gain. Look, absolutely we did. But look, if you're sitting at 1,600% gain, at some point in time, you've got to lock it in. And we decided to lock it in. Well, we were happy with the outcome, even though it's gone up. We never chased it afterwards. But as you can see there, it has fallen off the cliff since March 2020, and it's gone down from $60 down to now 14. So anyone holding this stock at the moment would be feeling a lot of pain, but we have been on record to say that avoid this stock. There has been issues. Next stock to avoid at the moment also is another energy company, AGL. While on one side, Ed, energy prices are rising, there is a lot of traction in this sector. Well, this company, they can't buy a trick. They did get an offer recently to be bought out, but they've rejected it, and now the stock's back down.
Yeah, this is another stock. We've been avoiding it for almost 2 years. We've been telling members it's been one of the worst performers on the ASX, if not the worst, in the top 100. So, yeah, they're about to split the business. There was a recent takeover offer, which was rejected by the company. The only way you would have made money out of this stock in the last, well, I don't know, 5-6 years is if you bought it at around $5, which was around October last year. Everyone else has lost money on this stock. So, as you can see, there was a short window to have a speculative play on it, but a purely speculative. I mean, no serious investor would have bought this stock, and now it's contracted sideways. So waiting for the split, and we don't believe there'll be a superior offer. That last offer was a pretty good one, but they didn't accept it. So energy costs are rising. You know, their debt facilities only going to rise as interest rate rises. It's fundamentally weak. Its return on equity is terrible, and it's just been loss after loss. So absolutely a stock to avoid in the future.
Sure, thank you, Ed. All right, now let's have a look at it. Before we look at a few stocks to buy on our list today, well, last financial year, this was the top 10 stocks that were out of the ASX 200. And we are proud to announce that we got the first, the third, and the fifth. It just happened to be, it wasn't planned, but the 1, 3, and 5 out of the top 10 stocks on the market happened to be Fat Profits recommendations, and Chalice Mining was clearly the best stock on the ASX. Huge gain of 7,000% plus. Number 3 was Hub24, and number 5 was Orocobre, which is the lithium producer. Now, just very briefly, Chalice is currently hold, so we're not recommending any buy at this point in time. We're just holding it. They've had huge discoveries in their Julimar project in Western Australia. They've also got a nickel, copper, and gold projects as well. And they've had some huge discoveries. So that company's now become one of the top 200 companies. We've had plenty of members who have bought this company over the years and made some serious life-changing decisions. So this is an example. Grant, he's only 33. He's been referred to Fat Profits by his father-in-law Ian, and recently his uncle Rod has also joined us as well. I've spoken to Rod as well as Grant. He only invested $5,000 because obviously Chalice was a small cap, bought it early, 12 cents in 2019, and he put in another 3,000 at 18 cents as he started to see some movement. And he's put in a little bit more money later on at 350. His return is more than $500,000 for a 33-year-old guy. It is life-changing, no doubt about it. And of course, he's very happy. His whole family are very strong advocates for Fat Profits. You would be the same. And this has been a great outcome amongst many others. So you can see on the charts, we bought it at 12.5 cents in 2019. Stock didn't really do much for the first year or so, slowly started moving, and then it took off and never looked back. So we're still holding that stock, and that has been a huge performer. $10,000 there would currently be worth $730,000. So that is a hold at the moment. That was the best performer on the ASX. Next up is Hub24. That's a financial technology company. Ed, just maybe a quick word on Hub24. They've had fantastic results pretty much every year for the last 6 years.
Yeah, it's a financial platform, does all the tax reporting for the managed portfolios. Just a growing business. There's been potential takeovers over the years which have failed, and now Hub is actually in a position to take over some smaller fintech businesses here in Australia. But you can just see all the numbers there. I don't need to go through them. It's all up. So
Absolutely.
Making plenty of cash, and it's a company that's well supported now. You know, we got into this stock again. I started back in 2011, but this is a stock that we got into back in 2013, I believe.
Yes.
At around $1 a share. And you can see that it's just been going up all the way. We've held it all the way through. I don't believe we've done a sell half on this stock yet. There was probably a window there at over $32, but we'll probably look at it at some point. But this is just a business that will absolutely continue to grow and is well cashed up. So once this mini crash is over, this business will be on the acquisition trail in our view. I think it's too big at the moment to be taken over, but you can never be too big. But we believe it itself will be on the acquisition trail at the end of this current sell-off. You can see there, 10,000 invested from the start, a whopping 175,000. It's actually realistic because I have spoken to members. The fact that they bought it and we've never put a sell, that actually own this stock. I've got a guy, he's made over 350,000 out of his stock. He keeps reminding me. And he keeps ringing me, and he wants me to pick another one for him. I just tell him that they're in the reports. You don't need to ask me. I mean, there's heaps. Collins Foods. There's a whole bunch of examples that we've got. Stocks that we bought at $1. My net phone back in the day that went 10 times. ARB, four-wheel drive accessories. There's heaps of them. You know, Chalice that we just spoke about. There's many there because we haven't taken a profit on these stocks. So they just keep going up. Yeah. So that's just another example, and that's currently a hold recommendation.
Yes, yeah, we're not suggesting buying this. We will come to the buy recommendation just shortly, but next we'll look at two stocks to sell in the market at the moment. So first up, we'll look at domain.com.au, that's the property stock, and the next one is Sonic Healthcare. So let's look at Domain first. We held this time. 2018 was our first buy at $3.45. We have bought it a number of times between then and now, and recently we've sold at $5.38. So what's our take on this stock?
Yeah, look, we put a warning out to our members that there's been a boom in these tech, I guess, property stocks, online property stocks like realestate.com and Domain in particular, the one that we cover. So we decided to take a profit on that stock at around $5.38, and you can see on the charts what's happened since. So the stock is currently trading. It dipped below $4 recently, but it's currently trading around that $4 mark, I believe. That was a fantastic timely sell. And you know what's happened in recent times is that all technology stocks, online stocks, have been heavily sold off globally. So not many stocks were spared. There's been a couple of tech stocks here in Australia which are still going okay. I think WiseTech Global and also Altium are still okay in a pretty good position, but everything else has pretty much been slaughtered. Block's going okay, but this one here unfortunately was not spared. But there's still plenty of room to grow in this particular stock, but at the moment we're sticking. It's a hold actually in the reports after our sell half, and we don't believe there's an opportunity there in the short term. But timely, it's all about timing in the market, so we definitely got this one right.
Yep, absolutely. Next up is Sonic Healthcare. Just a quick word on this one. We've held this stock since 2016, 1780. It has actually performed quite well. Obviously, there was a drop in March 2020 when COVID happened. We got in again and bought more. And recently, when the stock hit just under $40, we've taken a half sell. So stock has actually since then pulled down, and recently it's come down to about $33. So look, this is another example of when we suggest to buy and when we sell. We try to get the timing right, but obviously not all the time we're going to get it as good as these examples, but we get it right more often than not. So it's currently also under review. Now this table here shows you some of our sell recommendations. So you can see clearly Boral at the top there. This is all over the last few months. So Boral was a great example. We bought it at 405 and sold it at 741. That happened to be a great timing because then it's actually come off and it's now $3 something. So the stock since actually come off and it's now $3 something. So you can see the winners and losers now. We don't get all of them right, but we do get quite a few right. So you've got 10 out of 12, which have actually performed well for us. So this is just another example, okay? Now, let's have a look at two stocks to buy. So firstly, we'll give you the first one, and then we've got the second one a bit later. So Nufarm, Ed, is the first recommendation. So why Nufarm? What's going on here?
Yeah, obviously their business is exporting seeds, sunflower seeds, one example of many of their businesses. But the global demand is clearly there for soft commodities. So with supply chain issues globally, these type of stocks are very high in demand. As we slowly come out of this pandemic, we're not out of it yet, but the demand globally for agriculture, as soft commodity prices have increased, the demand for their product is astronomical. So they just reported recently in February, the reporting season, the share price rose to about $5.50 on the day. So this stock is very, very well positioned for growth. Just got the chart wrong, Roger, but that's all right. We'll keep talking about that.
Yeah, but, I apologize. Yeah, I just realized. Yeah, apologies, guys. For those of you watching,
anyway,
we actually got Domino's chart here.
Yeah, we'll talk about Nufarm. Well, actually, let's talk about Domino's because we've got the Domino's chart here. So Domino's reporting back in Feb wasn't as great. So you can see that stock, it peaked at around $160 per share in September last year. We initially bought this stock at about $51, so we're more than doubled. We did a sell half at about $110, 105, 110. So that was fantastic. It's 100% return. We put more buys along the way, as you can see, around $86. And then it peaked at 160, I think it was 168. So when it came back, we have been buying at lower levels, and it's currently trading at around $80 per share. But this stock, what we're backing here on our buy is its rampant store growth. So they're still opening stores. They use Dragon Tail technology. They're actually classified as a tech stock, not a food stock, believe it or not, because their cost of food is, if anyone's even eating a Domino's pizza, there's not a lot on it. So their margins are astronomical. They've got a franchise model. This business will continue to grow. It's a contrarian play at the moment because it's come back to an undervalued position, and that's why we put a buy on the stock. So we believe at some point it will have another run to the upside, especially post this mini crash. And it's the #1 go-to for ordering fast food online, and that's not going to change anytime soon. So yep. Good opportunity there. Another round on this particular stock, and let's see how it goes.
Excellent. Thank you, Ed. So yes, New Farm is also a buy, as we discussed earlier. So before we look at a couple of other stocks, now we'll just get to show you a little bit about our own performance so you can measure us versus how you're going in the markets. So this is an annualized return of our Australian equities in Fat Profits portfolio. So we've been performing at 17.8%, let's call it 18% per year for the last 21 years in the market, versus the ASX, which has gone up 8.5% per year. So we've been outperforming the market by over 9% per year. So that is a huge result, given that that's been achieved not over the last 1, 2, or 5 years, it's been over the last 21 years in the Australian stock market. And look, we are proud of that and we're not shy. But the one thing which we will be clear about is we don't get it right every single year. We're not here to just, beat our chest and say, look, we are the best. Because look, we're normal, just like everyday investors, but we're just better at stock picking. So if you look at 2020, we can see we performed at 20% and the markets only did 3.6%. So we actually did a very good job that year. We're happy with that. 2019, look, the markets had a fantastic year, let's be honest. They did 24% and we were only at 19%. So look, the markets got the better of us by about 5%. We could have done better, but we didn't. So look, we'll take that on the chin. But 2018, and look, this is where we really shine, is when the markets are down, that's when we really do our best work. So 2018, the markets were down 3.5% and we were up by 10%. So that was a pretty good outcome. 2017, we doubled the market. 2016, we again doubled the market. And look, in my view, 2015 was our best year because the markets were down 3.5% again, and we were up 18%. So that was an outperformance by 21%. And look, you give any fund manager that sort of number, I tell you what, they'll be drooling off of their mouth because this is stuff which they would love to have. So this is our results. The question comes back to you watching this today, because you're watching it for a reason, right? You're looking for information which will help you. You're obviously looking for an edge. You want to make some changes. Like if your results are the same as what they were a year ago or 2 years ago, well, there's a reason for it. Maybe perhaps you need to change it up. Maybe you need to do something different. And we are that different. So if you're watching this and you've got an open mind and you genuinely want to do better, well, we've got an opportunity for you to look at joining our service, okay? So one thing which will also help you understand this in dollar terms, look, if you had invested $10,000, only $10,000 back in 2000, when we first started this company, and you had invested $5,000 a year on top of that, and just followed our recommendations to the T, you would have grown that consistently from 1 year to the next at 17.8% annual returns. And the power of that over a long period of time is you'd currently be sitting on $1.6 million in your portfolio from a small $10,000 invested. Now, is it ideal? Will it be achievable? Look, possibly not to follow that exactly, but this is just to give you an example of what it could look like. Now, for some people investing a lot more money, you will know the power of compounding return. I think that's what we're trying to demonstrate. So hopefully you can keep that in mind. Now, Ed, we've got a number of people in our database who are members, like Penny here. So that people watching this webinar right now, they don't have to take our word for it, because we have a number of reviews from people like Penny.
Yeah, we've improved the service a lot in the last 2 years, Roger, and that's why we're getting these reviews. Actually, since 2019, we've made a lot of changes. A lot of people on the phones, our people, in particular, our account management team, which is far more superior and supportive. And it's actually a smaller team, but it's a more efficient team, and it's servicing our members every day. That's the differentiation between us and the rest, and that's why we're getting these reviews now, because as part of a subscription, our members are getting, personalized support. They can ring their account manager, they can email the account manager with questions regularly and get those questions answered timely. And our members, they're doing well. They're actually telling us they're making money. So, and that's the essence of our service. It's to make you money over a medium, long-term period of time. And these are, Kenny, sorry, what was her name? Penny. Penny, I think I've renewed Penny twice since I've been here, but I never renewed her last time. But I know she's been with us for over 10 years. But there's a whole lot. I think we've got about 160, 170 5-star reviews, and these are just a fraction of our members. We've got close to, I think, 18,000 paying subscribers at the moment. So yes, it's a small percentage of them, but the ones that are absolutely passionate and feel like they need to tell the rest of the investment community about our service, they go up and put a review themselves. So it's very pleasing and encouraging when we see Alan Jones. I've spoken to him a few times. I don't know who Nick is, but these are outright reviews. And there's a couple of people I've spoken to recently. I don't know if they'll do a review or not, but we had a couple of mystery stocks, 2 in particular, from the start of this year, from I think even in December, on these webinars. One small cap gold mining company, which has more than doubled in the last 12 months. But we've had people join our service off these webinars that have told us they bought into these stocks. Like, obviously, when they joined, we told them the names of these stocks. And they've recently told us, one guy, he's a first-time investor. I cannot believe he put $300,000 on this stock. But he actually rang me back and said, I've made $60,000 out of this stock already. And I said, I hope you haven't sold. He said, no, because what's happened in the last, I think, 2 weeks, the stock is broken out. It's broken out to the, you know about this because I've told you, right?
Yes.
Broken out to the upside. He's probably in $100,000 profit on that stock. But me personally, would I have put $300,000 on stock? Absolutely not. Maximum, probably 20K max, because it was a small cap stock. But he's over the moon. So he's similar to that other on Chalice. But he put the right amount. The guy that invested in Chalice put under 10,000 into that stock, which is more appropriate. Yeah. And he's got a phenomenal return. So he's recommending everyone, his family, friends, colleagues, to join our service. He thinks he's going to make it on every stock. Yes, over the long term, you probably will get similar returns, but over the short term, he just backed one. We would rather you spread your wings wide rather than thin. The more stocks you've got in your portfolio, the more you'll be able to follow our performance, rather than relying on 1 or 2 winners in the short term. You should spread your money across multiple stocks. But these are black and white reviews. We're very proud of those reviews, and we've got plenty more, I'm sure, to come, because we're working very hard to make sure that we are the #1 research service for self-guided investors in this industry, and it's a small fee to pay to get these type of returns.
Excellent. Thank you, Ed. All right, let's have a look at what we've looked at so far. So our performance is definitely a tick in the box. You'd be hard pressed to find someone who's performing better than that over a long period of time. 21 years in the market, with the second longest company for stock market research in Australia. So that certainly is a tick in the box. And of course, we have management who've been doing this for a very long time. They're well respected as well. So today, what we're going to do is we're going to show you some special offers as an incentive for you to join our service. And in a moment, Before we give you another 2 buy recommendations today, I'm also going to show you our members website now, so you get a bit of a sneak peek on how it looks like. It's very easy, simple. So these are the 3 types of memberships we have available. First one is a standard membership, then we've got a premium, and finally we've got platinum. So the difference between the 3, it's not that much, but you need to understand it. So the top 3 benefits, I'll just read them out. The daily Fat Chat market commentary. So that's the first benefit, which is standard across all the 3 memberships. That's a morning email you get every day from our CEO, Angus. He's the fund manager as well. So it hits your inbox every day about the market update. Very good email for you to be watching every day. Second benefit is weekly members only webinar. That's every Thursday, live at 12 p.m. for 1 hour. So every Thursday, live at 12 p.m. It is interactive. You can ask questions from our panel, and members love it. Now, if you missed the live webinar, you can replay the recording later on. And we know that everyone's busy at probably midday. So you can do that. Number 3 is a Friday Fat Wrap. That's a wrap up of the week on a Friday evening. If you missed any highlights during the week, you can catch up on a Friday evening. So that's the 3 benefits. They're all across board. Now, we've got 4 key products. That's the main juicy stuff people pay us for, is our weekly report. So first report is Australasian equities. That comes every Tuesday night. It comes with 5 to 6 stock updates with buy, hold, and sell recommendations next to all those stocks. And this report is our flagship product. It covers Australia, a little bit of New Zealand, and a little bit of Asia. The majority is Australian market. It covers most of the main sectors like financials, tech, healthcare, industrials, some mining companies as well, mainly your blue chip stocks. And do you remember earlier in the webinar, you saw our dividend income portfolio, which is returning 18.1% per year for the last 10 years. That is also included in this Australasian equities report. So that is full of bells and whistles. So this is a must-have for Australian investors. Second report we publish is a global mining report. Now, even though the name says global, don't be fooled by that, because 80% of the mining companies in this report, they are Australian mining companies. The remaining 20%, they are international companies. So it's certainly, if you were looking for growth within commodities, junior companies up to soon-to-be producers, as well as top producers in the Australian market and some international, this is a must for that. Third is Global Equities Report, which covers international markets like US, Asia, and Europe. So if you're an international investor or wanting to be one, then you must have that as well. It gives you weekly stock updates and recommendations. And last but not least is UK Equities Report, which is obviously for the UK market. Now, if you're a standard member, you can pick any one out of these 4. If you're a premium member, you can pick any 2 out of these 4, plus you will also get a premium account manager, which means someone like an Edward, who you're listening to today. He's been with us for 11 years. He looks after clients, and he can help you with your questions about stocks, as well as the market. So you will have direct contact of an account manager. With the Platinum service, you will have all the 4 reports as well as the account manager. Now remember, either one you choose, they are most likely tax deductible, and we can invoice them to your self-managed super fund or your own personal name or your trusts, and you may be able to claim that back when you're doing your taxes. Now, before I get involved with the special offers today, I would like to take you to our website and show you the members area. So this, I've logged in as myself. As you can see there on the top right-hand side, I'm logged in. It's a very simple website. You can see the members homepage. You scroll down, you'll see a video, which is an introduction to the website. It's very simple and easy explanation. But we have these 4 products that I've just explained, Australasian equities, and this covers the latest weekly report. You can see all our new recommendations here in a table. You can see our Fat Profits portfolio of stocks that we're currently holding. There's about 55 stocks. Past recommendations, including Magellan that we just looked at. Any alerts, we will also alert you midweek if there is an announcement on a particular stock. We also have our latest income portfolio and the report, which is every quarter, and which we looked at earlier as well, the dividend stocks, which our retired and semi-retired investors really want. And finally, we also have all our recordings of our weekly webinars placed here, and you can replay those recordings at any time, and podcasts. So all this is available for each report, and you can subscribe to all 4, or certainly the 2, the Australian equities and mining, or the Australian investors. Now, by now, you're probably thinking, hang on, what's the price? What's the catch? So look, we'll tell you the prices now, because most of you would have seen it. So this is all in our public website. When you go there, you go to products, and you scroll down, and you'll see our bundles. So we've got the standard membership, premium, and platinum, and these are the prices. So you've got 1-year rates, you've got 2-year rates, and of course the 2 years are slightly cheaper. So most people, when they join on premium or platinum, they usually go for 2 years because it's slightly cheaper, and obviously saves you for paying the same again next year. So these are the normal rates. Okay, now Ed, obviously with that said, we have some special offers today, so I'm going to pass it on to you now.
Yeah, and just on that, Roger, look, most new members join on the website. They don't speak to us. Usually if they join for the premium or platinum, one of our account managers will call up, introduce themselves, make sure they're navigating the website with their username and password, and make sure they've started receiving emails. But the reason anyone that's watched these webinars in recent times knows that we never put prices up, discounted prices. We generally offer a percentage of discount, but we've decided it's a fantastic time to join when the market is down. This is the best time to join us. So we're going to put it in black and white, and we're going to offer prices which are basically a no-brainer. It's an incentive to join, so you're not going to pay the website prices, you're going to pay these prices. So the standard membership, which Roger explained previously, is $1,095 a year. A lot of people join up to that, and then once they realise we specialise in mining, they upgrade to premium. We do that over the phone for them, and they just pay the difference, which is normally about $600. So $895 is the special for 1 year for our standard membership, and that includes the daily fat chat, which comes to you from Angus Geddes. So remember, I spoke to you earlier, our members get a report daily, a macro report from a fund manager, which is very rare in this industry. Okay, so we're not providing insights, we're providing forward-thinking predictions on a daily basis. So Angus, yes, he'll provide some insights to what's happened overnight, but he'll give you his own interpretation and forward prediction on all areas of the markets, and that starts with the overnight wrap from the US. Okay. The premium membership, which is our most popular membership on the website, retails for $1,545 for 1 year. That's what most new members sign up for because they know we specialize in mining. What we're going to do today, members that want to join today, we'll offer you not 1, but 2 years for $1,795. That's a massive discount. Annualized, that's $899 per year. If you commit to 4 years, it's 50% off. Right, so $2,795 for 4 years, an annualized rate of just $699 a year. And anyone that watched our previous webinars, I was offering portfolio reviews for platinum memberships or for memberships 2 years plus. We simply don't have I didn't have time to do all those reviews, so we have to simplify it. So if you commit to a 4-year membership, we will offer an annual portfolio review. So you send me the portfolio or one of our other account managers, and we'll organise a one-on-one portfolio assessment and review your portfolio. So that's
just to clarify it. So that's for the 4-year membership. So that's obviously the cheaper rate as well. So we're rewarding the decision to commit for 4 years, because that's a normal rate for 2 years, 27.95, correct?
And that's an annualized review. So you send us your portfolio once a year, and we'll review it for you one-on-one. All right, so that's a very unique offer in the industry. Okay, and I personally, as an investor, I would definitely take advantage of that, especially in the current environment.
What about platinum?
Yeah, if you commit to platinum, that's for your more, generally for members who are a bit more savvy, members that have a self-managed super fund and want to invest globally, don't want to invest in managed funds or ETFs, they want to buy individual stocks, will generally pick our platinum members. So a lot of our long-term members, they've been with us for over 10 years, generally renew for platinum. They get all of our reports, and they generally have a couple of international stocks like Google and Apple, and some of those like Sony and Activision, which is going to be taken over shortly. It's been a great success story for us. And we just had a couple of sells recently in the US market as well. So we're consolidating that particular portfolio, but that covers, US, Asia, and Europe as well. And with that, if you commit to 2 years, it's 2,995, so that's 1,500 a year. And if you commit to 4 years, it's 4,695. So that's our 2-year offer on the website. We'll give you 4 years for that price today. So lock that in long term. You'll get a portfolio review every 12 months. You send the portfolio in, we'll review it for you. That's actually our most popular membership at the moment for our current members. So we're actually offering that to current members at the moment. Those 2 offers that were in the green, the 4-year premium and also the 4-year platinum, is very popular at the moment for our current members. So we're going to offer the same price to you today. Okay, so here's the poll, Roger. All you need to do, click the membership that you're interested in. If you'd like to discuss it further, click that option and we'll have a chat over the phone. We'll endeavor to get to you within the next 24 hours to discuss. The webinars I'll be doing on the weekend, we probably won't be able to make those calls on the weekend. So we'll get back in touch with you on Monday and we'll have discussions, but feel free.
So Ed, we're getting some questions. Sorry, while the poll is up and I'm getting some inquiries here, I can see them. Some people, in fact, there's quite a few on premium, and most people are sticking on premium 4 years. But look, platinum as well seems to be getting some hits, because I suppose in today's market you want to look at international. But I'll take a couple of questions here. So one question has just come from Eddie. Eddie saying, great presentation, guys. I'm enjoying listening to your successes and views. His question is more about the portfolio review. He's saying, if I commit to the 4 years on platinum because I do want to invest overseas, portfolio review, and he's saying I'm currently holding 25 to 30 stocks. So will you be able to suggest trimming it down and getting rid of some?
Look, just depends on the stocks. So obviously we're stock pickers at the end of the day. How many stocks you've got in your portfolio versus capital amount, we'll have a look at it, but generally we focus on the individual stocks themselves. So you could have 30 stocks. If they're all fundamentally sound, we'll probably recommend a hold, but it's very rare that I will do that. So it just comes down to the stocks that are in the portfolio, really, and we'll give you some ideas about the diversification internationally. But most portfolios I'll do probably 80%, to be honest, are ASX stocks, a mixture of income and growth. And generally the ones that I've seen lately, the better ones, the ones that don't have exposure to the tech sector, and it's in particular too many small caps, which have been hit pretty hard lately. So we'll have a look at that at the time. But a lot of our new members that have been in the market, 10, 15, 20 years, they generally have a good idea of what they're doing. So that most of those individuals, unless they're performing very poorly, would just follow the advice that's in the reports, and that'll be enough information for them.
Sure. Yeah. Okay. Thanks, Ed. Another comment, in fact, more like this is from John and Margaret. Seems like they're watching it together, saying we're enjoying the presentation. We used to be a member many years ago, and we've been getting some information from you. Watched today's webinar, and look, we did decide we're not going to sign up today, but watching the presentation, we've decided to open our mind and make a change. So the question that they have, and good on you guys to open your mind, because look, nobody wants to pay if they don't have to, but the reality is it is an opportunity. So they're saying if we decide to join on the premium service for 4 years, because that's the best value for money, can we upgrade to platinum later down the track and pay the difference?
Yeah, absolutely. We have a lot of members that join on the website. They pay $1,095 for 1 year, and then they realise they'd like to invest in smaller mining companies, and we just do an upgrade over the phone. It's not a problem. So you can upgrade anytime. But look, unlike other services, we only really have one membership. It's just a matter of whether you want to invest internationally or locally. Most of our competitors have multiple subscriptions, so that's not what we do. We're not, as I mentioned earlier, we're not a direct marketing business. Where people trust us because of our performance. They trust us because we've got skin in the game. We've got 9 separately managed accounts, and we report on those managed accounts every day. So upgrade is not a problem. You can do that any time. We have more recently, I'll be honest, we've had a lot of members that have just subscribed to Australian Equities, some of them for over 10 years, that have finally decided they want to catch on the mining boom. So they've come in and upgraded their membership. Some of them have got like 3-4 years left, and we've just upgraded, just added mining for 3-4 years. Just for a nominal rate, that's fine.
Yep.
But yeah, a lot of those members who wouldn't touch mining in the past have realised they're missing out. So it's the whole fear of missing out scenario. So
Yep.
I've upgraded plenty in the last probably couple of months. Yeah.
Okay. Thank you, Ed, and thank you for all those of you who've opened your mind to trying something new and willing to change your results, because unless you change what you're doing, you're not going to get the different results. So congratulations. We will get in touch with all of you. For the others, look, if you're still not convinced, well, look, there's not much else we can do other than give you some encouragement. But if you're still looking for just free information, look, we'll give you a couple more free stocks, and hopefully you might change your mind down the track. But look, parachutes and mines have one thing in common: they only work when they're open. So I thought I'll throw that in. I like that. Now, Domino's Pizza, as we've already covered earlier, Ed's already mentioned that, so we won't spend too much time, but this is a buy recommendation. So for those of you looking for a free stock, well, this stock has got excellent earnings, growth in stores around the world. As you can see there, in the first half of 2021 versus 22, the store count has gone up dramatically, thanks to Japan, where they've opened 800 plus stores, and many other countries. So earnings are on the way up, but they have been let down lately due to some cost issues, some labor supply issues, as well as some store issues in Asia. But we do think that that's an operational challenge that they will overcome. So currently it is around $80 odd, and we do see this as a compelling buying opportunity. So that's one stock for you. Now, the next one is Whitehaven Coal. Now, you might remember, for those of you who are watching these free webinars but not interested in joining our service, that's fine. You may have seen this stock. We published that in the last 2 or 3 webinars, and we've given that away as a free stock tip, and you would have made money from this. So you're welcome if you have bought this stock. Now, we have nearly doubled, $2.08 we bought it at, and this stock has gone past $4, nearly doubled. And we've given this free tip away over the last few months when it was trading $2.50, $3, $3.30. It's now past $4. So if you're making money from free stock tips, imagine what you could be doing if you were actually a paid member. So that's something for you to keep an eye on. And finally, Ed, this is a hidden gem that we're going to give away to people who will be joining our service today, because this stock is looking extremely oversold, and I've got some fundamental ticks in the boxes, if you like. So very briefly, without giving the name away, because we've got to do the right thing by paying members, but this stock is in financial technology, and their revenue has grown and grown and grown over the last 6 years, as the numbers are showing here. And this chart will show you the funds under administration over the last 3 years, and you can see now it's at record level, which they've never experienced before. $49 billion they are managing currently. But the stock recently, and we've held this stock from 19.5 cents a share up to as high as $1.60. Recently, it's actually pulled down to around 70 cents. So in our view, this is an absolute compelling buy. There's a couple of reasons behind the sell-off. One of them is that they received a takeover bid for $1.50, which they rejected. So that's had a part to play, and now that buyer has gone away. But the other was there was some soft results this time around in February because their costs for technology and marketing actually went up because they've gone aggressive with their marketing and technology spend. But that's a good thing because we do think they are going places. And at current levels of 70 cents, we do think that's an absolute steal. So for anyone who's looking for an undervalued stock in the financial technology space, it's a medium-sized business valued at around $500 million. This is a compelling buy opportunity. If it goes back to where it was, $1.50, you are going to double your money. So if you're looking for something good, please talk to us when we contact you, and we will be happy to give that away. Now, finally, look, if you have any questions about the service or anything that we haven't covered today, you can call us on this phone number. You can email us at info@fatprofits.com.au. And if there's anything we can do to help you get a better return in the markets, provide any further information, or help you join our service, please don't be shy. We don't bite, we promise. But other than that, look, we are out of time. So we thank you for your company today. We really hope that you've got something out of today's webinar. For those of you who are joining our service, thank you once again. We look forward to working with you. For the others, look, we wish you all the best on your own, and we hope whatever you're doing gets you the right returns. And finally, Ed, I'm going to pass it on to you to say your final words.
Yeah, absolutely. And just quickly, you know, the reason we put these hidden gems at the end is because our track record is fantastic. The last two hidden gems, we showed you Whitehaven Coal, and the one before was a small cap gold stock. We can't give it away because it's still on the run at the moment, and new members and all, well, most of our members that bought it have made money out of it. So our last two hidden gems have spiked. One's up, I think, 80% in the last 12 months. Sorry, 80% in the last 2 months. It's really 3 months. Sorry, last 3 months. And the one previous is up around. That's up around 70% in the last 3 months. That's been achieved the whole time we've been putting these webinars up. So when the members join, they ask us for the name of the stock. And if you join, we'll tell you, you know, we've just told you one, which is Whitehaven. This next one, we're very confident, the one we just showed you, it will be a turnaround story in the next 6 months, possibly 12 months. It might take a bit longer, but, you know, members have made astronomical returns out of these hidden gems. But don't just rely on those stocks. We have 20 or 30 stocks right across our portfolios that have given our members similar returns. So there's a lot of reasons to join. Most people try us out at least for 1 year. Savvy investors will try and, you know, lock in the annualized savings and lock in those longer term memberships, especially if you've used research in the past and you know how it all works and you know the benefits. We'll generally go for the longer term memberships. But new investors, we'd love you to try us out for 12 months. Have a great day, and hopefully we'll talk to some of you very shortly.
Okay. Thank you, Ed. Thank you for your company. Bye-bye.